Welcome to the introductory lecture on the MASASP methodology. Its aim is to properly design and thoroughly assess a combination of trading systems, which can be thought of as an absolute return investment system. This methodology encompasses 5 tiers, and each tier is targeted to a specific professional role. The gold blocks in this slide indicate the software component which the given tier relies on. Nonetheless, we are going to focus just on the conceptual aspect of these analytical components. Let's start with the bottom tier, the trade construct tier. It provides the trade construct which stems from research and which is relevant to the financial analyst. With this term, I mean any kind of analyst, either fundamental or technical. Above, we have 2 tiers which are relevant to the statistician or the data scientist. The statistical assessment tier deals with trade construct optimization, taking account of predictors, variables other than the traded contract price. The second component, which stands for segmentation, is meant to select predictors and build a predictive model based on them. The H0 component aims at assessing the statistical significance of said model. Look, from now on, we will use the terms trading system and model interchangeably. Then we have the Oos Evaluation Gear, which stands for out of sample evaluation. The test component tests the model on a sample other than the sample utilized for building the model itself. That is a requirement of the honest assessment practice, even though inferential statistics tests have been adopted earlier. The performance here is just measured in terms which are meaningful to the statisticians, in terms of expected value. Then we have the perf component, which stands for performance. Here, trading-specific performance metrics are utilized. This component, differently from all other components mentioned so far, makes possible to evaluate not only a single model, but a combination of models. Here we go to the next 3 tiers, which are risk management tiers actually, and are relevant to the risk modeler. The sensitivity analysis tier has this purpose. The boot component, which stands for bootstrapping, checks whether the model is robust with respect to test sample alterations, which in turn makes possible to figure out how the model behaves if future time series are going to be quite different from the past ones. The sense component, which stands for sensitivity, checks whether a model which has already been deemed valid at the previous tiers is still viable with respect to the financial market constraints, namely transaction costs and time decay, if applicable. Then we have the core risk management tier. The SL component, which stands for stop loss, will be discussed on Lesson 1. This provides a basic loss limitation policy based on a stop loss setup. The risk component provides the generally adopted risk metrics, such as the VAR, the value at risk, the ES, the expected shortfall, the Sharpe ratio, and the likes. Besides, it tackles the issue of skewness and kurtosis of the profit and losses distribution, which shall be presented on Lesson 1. At last, it is also intended to assess possible underfunding schemes, taking into account the risk metrics and the margin requirements. The last component of this tier is the FX component, which stands for Forex. That makes possible to assess the risk related to foreign currencies. If the involved ETF or derivatives are US dollar denominated issues and the investor goes for deposits in euro, Swiss franc, or British pounds, that is going to be relevant. Of course, all this stuff is applicable either to a single model or to the whole model combination. Here it comes the diversification tier. It has two purposes. First, to figure out whether the models featured by the combination are fit for being operated together as an ensemble. That is what the div component, which stands for diversification, is meant for. It detects possible model-to-model correlation. That is also termed contract-to-contract correlation, on the ground of the fact that models are supposed to be univocally associated with contracts, future contracts, or financial issues in general. Besides, the overlap is detected. That means how much and how frequently the models are on the market at the same time, which could pose a threat in terms of market risk. The second purpose of this tier is to figure out whether the model combination, which can be assimilated to an absolute return system, can work in conjunction with a buy and hold system, such as an ETF replicating the Standard & Poor's or the Nasdaq. The beta component checks whether a correlation exists, assuming the above said ETF as a benchmark, and the WGHT component, which stands for weight, reckons up the optimal asset allocation, taking account of both systems and considering possible underfunding schemes for the absolute return system. Here we can spot at a glance the complexity of the MASASP Methodological Framework. It encompasses as many as 12 analytical steps or components, which will provide the topics for the next lesson. One lesson for each component. At last, we have the key information document component, which provides a recap of all the metrics featured by the 12 analytical steps above mentioned. In order to keep the videos short enough, each lesson is divided into two parts, Part A and Part B. Here we take a chance to look at the framework from a higher level perspective. We can see that we have a financial analyst layer, a data scientist layer, and a risk modeler layer. The bottom layer, the one involved with trade constructs, represent just a 10% of the overall framework. Thus, it doesn't make sense to invest time and resources to optimize a single trading construct. Quite the opposite. Trading construct optimization is the core interest, if not the only concern, of many people who resort to freeware tools like Python packages or cheap backtesting softwares which can be downloaded from the internet. These people, unfortunately, really overlook what an absolute return investment system is about. Here we have a look at the course content. Each lesson is split in Part A and Part B, which are delivered as two distinct videos. Thanks for watching, and see you at Lesson 1.